when you get these initial breaks of the 200-day moving average, be a little cautious about the initial break. As I said yesterday, you want a bit of confirmation here. But here's what you need to know before the bell this morning. Got a lot of emails yesterday, and we touched on this yesterday morning because of this break of the 200-day moving average by the markets. And the question, of course, is this the clear signal that we need to reduce risk and the next big leg lower is coming for the market? Be careful with that. As I said yesterday, in particular, you can get kind of whipsawed into these things very quickly if you're not careful. So, working on a break of a moving average is risky at first. If you just take that initial break and start to sell positions like, oh, we broke this moving average, that tends to lead to these whipsaw effects where all of a sudden you kind of get caught on the wrong side of the trade, actually being caught out of the trade when it reverses. And a good example of this was back in March of this year when we had the regional bank crisis. Now, you'll remember at that time we had a lot of bad news coming out. Banks were failing. Clearly, a lot of pressure on the markets and certainly reason to be risk averse at that point. A lot of throwback to the financial crisis when banks were failing. So we had this big break of the 200-day moving average at that point, and certainly seemed to be good reason to sell stocks and get out of the markets. But then, of course, the Federal Reserve launched their program to bail out those banks, and the markets then immediately reversed, got back above the 200-day moving average, and then we had that big rise after that. Now, I'm not saying we're going to have the same type of rise here, but the point is this, is that when you get these initial breaks of the 200-day moving average, be a little cautious about the initial break. As I said yesterday, you want a bit of confirmation here. Yesterday, we kind of had a rally yesterday in intraday, certainly saw some buying. Market was unable to get back above that 200-day moving average, tried to do it, wasn't able to do it. So that's a little bit concerning. This morning, though, the futures are pointing higher, so we're going to make another attempt to get back above that 200-day moving average. If the market's able to do that, then that's fine, and the markets can do whatever they're going to do next. If we continue to kind of slop around and close below this 200-day moving average at the end of the week, on Friday, if we're below this average, then that's something maybe to be a little bit more concerned about. But also, as I said yesterday, we're also at a very low level. We're oversold on a short-term basis. So again, that suggests there's limited downside. Even with this break of the 200-day moving average, there's probably limited downside to the markets near term. Good bit of support right around 4,200, 4,150. So again, not a lot of downside risk. And particularly with the MACD as oversold as it is right now, again, another reason there's probably not a lot of downside. So if you're expecting another big leg down between now and the end of the year, we're probably not going to see that simply because the markets are very oversold. Sentiment is very negative. Positioning is weak right now. Big short position on the markets. And again, you now have buybacks starting back beginning this week, really, but picking up in November. So again, there's probably more risk of an upside move right now in the markets, that pain trade higher into the end of the year. Now, once we get into 2024, all bets are off. But for now, the risk is to the upside, at least technically speaking. That's what you need to know before the bell this morning.